Traditional versus Roth. What's the best approach? They're both tax-advantaged accounts. They're both great accounts, but which one leaves you with more money in your pocket or your bank account versus Uncle Sam's? Hey guys, what's up? I'm Erin and welcome back to the channel. Really, this question is about taxes. Do you think you're in a higher tax bracket today, or do you think you'll be in a higher tax bracket in the future? And honestly, it's impossible to know with true certainty, but there are ways to make your best guess, because at some point you have to pay taxes. The traditional versus Roth question comes into play when talking about employer-sponsored plans like the 401k, the TSP, the 403b, and the 457. It also comes into play when talking about individual retirement accounts, appropriately named IRAs. Now, the Roth versus traditional for each of these respective accounts, they're pretty darn similar. With a Roth, you contribute post-tax dollars, so money you've already paid taxes on, meaning that you incur your tax consequence today. When it comes to a traditional account, you contribute pre-tax dollars, so money you haven't paid taxes on yet. Once you get to retirement and start making your withdrawals, then you pay taxes on those withdrawals. So you kick the can down the road and pass the tax burden on to the future you. Now, outside of when you pay taxes on these accounts, there are a couple other distinctions worth noting. With employer-sponsored plans like the 401k, the TSP, the 403b, and the 457, first and foremost, your employer has to offer the Roth option if you want to participate in the Roth option. And your employer can only offer the Roth option if they first offer the traditional option of these accounts. But the good news is that 70% of employers who have a traditional plan offer a Roth option, and that figure goes up to 90% for employers with 5,000 or more employees. So you have to have an income from an employer that offers one of these plans. That makes you eligible because these plans are funded by payroll deductions. For 2022, the contribution limits for these plans is $20,500. In 2023, it gets a $2,000 boost, so employees can contribute a maximum of $22,500. For employees that are 50 and older, in 2022, you can contribute an additional $6,500 as a catch-up contribution, and in 2023, that will get a $1,000 boost, meaning you can contribute an additional $7,500 on top of the baseline contribution limits. With these traditional accounts, your contributions are tax deductible in the year that you make your contributions, but you really don't have to do anything on your end or report to the IRS because these contributions are made with pre-tax dollars from your income. So by contributing to these accounts, it will reduce your income accordingly. I'm going to dive into an example, but before I do, I just want to make a quick note. For our purposes here, we're going to ignore all other tax deductions. We're only going to look at the impact of a Roth versus a traditional. If your income is $100,000 and you contribute the max allowed amount to your 401k plan for 2022, so $20,500, your income that gets reported to the IRS would only be $79,500. And if you're a single tax filer on the federal level, instead of your tax bill coming in at $17,835, your federal income tax would be just over $13,000. That would reduce your tax burden by almost $5,000. Importantly, this would leave you with take-home pay of about $66,000. It's very hard to talk about income tax on a state level because different states have different tax brackets, and some states, my favorite ones, don't tax income. But if your state does have an income tax, it would impact your tax burden accordingly. So clearly there is an immediate tax benefit to using these tax-deferred or these traditional employer-sponsored retirement accounts. But on the flip side, let's say that you still have that same income, $100,000, but you decide to max out a Roth version of the 401k. In this situation, there's no tax deduction. You pay your full federal income tax burden on your $100,000 income, so $17,835, leaving you with about $82,000 of take-home pay. Then you max out your Roth, adding in that $20,500 for 2022, leaving you with take-home pay of just under $62,000. So there is no tax benefit today. Using the traditional version gives you a greater take-home pay to work with by the amount that it saves you in taxes. In this case, a little bit less than $5,000. Notably, the dollars that you contribute to a Roth 401k are more expensive than those used to contribute to a traditional 401k. After federal income tax, you're really only left with about 82 cents on the dollar in this scenario. So it's harder to come up with that $20,500 post-tax because really it's like coming up with $25,000 of earned income once you factor in taxes. But the perk of the Roth is that you're already paying taxes on your contributions each and every year. Once that money's in the account, it gets to grow completely tax-free. Then once you reach retirement, you get to take that money out completely tax-free. And bonus, because the IRS has already taxed you on this money, there's no required minimum distributions. So you can take out as much or as little whenever you want in retirement. That makes these accounts very attractive for your retirement years. With the traditional version, you contribute pre-tax dollars, you capture your tax deduction. Once that money's in the account, it gets to grow completely tax-free. Then once you hit retirement, it's time to pay the piper. You have to pay ordinary income tax on any withdrawals that you make. Also, these accounts are subject to required minimum distributions, meaning the IRS is tired of waiting to tax your money. So once you hit the age of 72, you have to take at least the minimum required amount from your accounts as a distribution and pay taxes on it. So let's say an investor contributed $10,000 to their traditional 401k every year for 35 years, and their portfolio grew to $2 million. Let's say in retirement they want to use the rule of 4%, and so they take out $80,000 every year. Using 2022 tax rates, they would pay $13,217 in federal income tax on their withdrawals, leaving them with just under $67,000 in take-home pay. Or let's say that our retiree finds retirement less expensive. They don't need $80,000. Instead, they factor in Social Security and perhaps only need $40,000 per year. So they're now in a lower tax bracket. They withdraw $40,000 and only have to pay $4,594 in federal income tax. Finding yourself in a lower tax bracket and perhaps needing a lesser income in retirement makes a huge difference to your tax burden. On the other hand, if they decided to use a Roth and contribute $10,000 every single year for 35 years, it would still grow to that same $2 million. Then if they wanted to use the rule of 4% and withdraw $80,000 a year or whatever amount they wanted to do, they could withdraw it completely tax-free. But remember, coming up with $10,000 for a Roth is more expensive than coming up with $10,000 for a traditional retirement account. You've been paying higher taxes each and every year based on a Roth decision. It's just harder to come up with that $10,000 for a Roth rather than a traditional. If you have a $100,000 income, it's like coming up with over $12,000 of earned income. So essentially, we have to consider the lifetime tax burden. Over the course of those 35 years, this worker in the 24% tax bracket would have already paid over $76,000 in taxes over those 35 years of investing with and putting money in a Roth versus a traditional account. You pay taxes on both a traditional and a Roth, but you have to decide when's the most opportune time to pay taxes. When are you going to be in the lower tax bracket, now or in retirement? If you expect to be in a lower tax bracket when you retire, a traditional account makes more sense. If you expect to be in a higher tax bracket in retirement, a Roth makes more sense. Pay the taxes today and get it out of the way. And if you expect to be in the same tax bracket, well, then it doesn't really matter much either way. Your total tax burden will be the same. You can make a general guesstimate on when a traditional or when a Roth might win out. When a Roth might win out. If you find yourself in the 24% tax bracket or lower, a Roth is a great go-to. You're already in the lower tax brackets. For a single filer, that would be an income of $170,050 or less in 2022. And for those married and filing jointly, it's $340,100 or less. After that point, tax brackets take a hefty jump up to 32%. So in that case, if going with a traditional gets you back into the lower tax brackets, that can be a better choice. It's worth noting that most people fall into these income ranges, and also important to note that you can participate in a Roth or a traditional no matter what your income. There are no income limits on these employer-sponsored retirement plans. It's also worth considering that tax rates are subject to change over time. This graph shows how income tax rates have fluctuated in the past, and with our national debt continually on the rise, it's hard to imagine that future tax rates will be lower. When a traditional account might win out. research shows a similar theme. People tend to spend less in retirement. In fact, on average, people tend to spend about 10% less each decade after they retire, on average reducing their spending by about 1% per year. Of course, everyone's retirement looks different, and only you know what type of retirement you're planning for. But if you're a higher income earner during your working years planning for lesser income needs in your retirement years, well then a traditional account could be a great way to go. But just keep in mind, there's no way to guarantee what your income needs will be because life has an element of unpredictability to it. And if you accumulate significant assets in a traditional account, there comes a point where RMDs or required minimum distributions become a concern, because there comes a point when RMDs alone could create a hefty tax burden. Of course, you could go the route of a backdoor Roth, the process of converting a traditional account to a Roth account, helping to alleviate some of that future tax burden in retirement, moving that tax burden to today. That is beyond the scope of this video. I will do a video on it in the future, but that is an option. And it's very important to consider that 64% of all US households live paycheck to paycheck. In fact, 52% of households earning $100,000 to $150,000 a year are living paycheck to paycheck. For those households living paycheck to paycheck, contributing to a traditional account very well could be the better choice because it gives them a tax break today, putting more money back into their paycheck, which could be essential to making ends meet. On the other hand, perhaps both could be best. Important to note, when deciding to make your contributions, you don't have to approach it as an either or. You can actually split your contributions among the account types. You could make a 50% contribution to your Roth and put the other 50% of your contributions to the traditional. So in that sense, when you're making your tax bet, will taxes be higher now or in the future, you're only 50% wrong and only 50% right, but it helps to mitigate the consequence and it helps to split the difference. It is important to note, if you go this approach, the contribution limit, you want to make sure not to exceed it, because if you're splitting funds, it can be easier to surpass that contribution limit. So the contribution limit does not change if you're splitting your funds between the Roth and the traditional type. I actually really like this approach because it gives you more buckets to work with in retirement, a taxable bucket and a tax-free bucket. And having more buckets to work with in retirement can make a huge difference. For example, let's say you have a year where you're on the cusp of being bumped into the next higher federal income tax level. Well, in that year, instead, you could draw on your Roth bucket, and that way it would not impact your taxable income, thereby keeping you in the lower federal income tax bracket and reducing your tax burden. Similar considerations have to be made if you're deciding between a traditional or a Roth IRA. One note about the Roth IRA are income limits. Threshold amounts at which you become ineligible for contributions. The max you can contribute to an IRA in 2022 is $6,000 and $6,500 in 2023. And in each year, there is a $1,000 catch-up contribution if you are 50 and older. Now, whether or not you decide to go with a Roth, a traditional, or a combination of the two, one thing is for sure, you are far better off utilizing these accounts as they are both great options for saving and investing for your future. Inevitably, they both offer tax-free growth, which gives your money the greatest growth potential. So what account do you prefer to use? Leave your answer in a comment down below. I post new videos every single week. If you got anything at all out of this, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I hope you have a good one. Bye. Then you tape pocket or with you. Nope. Versus Roth. Best approach. You put 401k. I missed. 401k, the TSP, the 403b, and the 457. We should add in another one because I have some breath left of these accounts. But you don't really have to do, I feel like I was really loud there. Reducing your taxable income accordingly. I don't like it. Accounts. Here's one of these plans. Dollars that you contribute. Roth 401k. I don't know. That you've already. You don't need $80,000. You get to take that lower tax bracket, I don't know, is a huge With the traditional version, income earner during your working years, I don't know, could have worked. In an attempt to mitigate because they can actually be a true guarantee. Will you be taxed? Okay, airplane's gone. Back to it. That's frustrating. I just realized that I used 2023 contribution limits and 2022 tax rates for this example. I have to go redo my numbers.